Good evening. Welcome to another episode of Whiskey and Wealth Wednesday. I am actually not drinking a whiskey, empty-handed tonight, but I am excited because we are going to go in a different direction here, change things up a little bit. We are going to continue to do Whiskey and Wealth Wednesday. However, that is going to be moved to a monthly installment. And then, because I just feel so strongly about this, we're going to start a new series called The Psychology of Financial Decision Making that's going to drop every Friday. Whiskey and Wealth Wednesday will continue to have, it'll be topical, current events, client questions, things along those lines, whereas the Psychology of Financial Decision Making is going to be more focused, of course, on perspectives and historical thought processes, and really making sure to limit the amount how mental biases can affect our decision making. So we're going to do a deep dive into that. But this week's Whiskey and Wealth Wednesday is actually covering a few different things. We're going to talk about the bear market that we're currently in, not to be feared, but to actually be understood. Secondly, high inflation. It's there. We're dealing with it. But what does that really mean to us? And then moreover, looking forward, what are some of the things that we could be doing to better our situation? Again, whether that's financially or emotionally, psychologically. So I hope you enjoy the upcoming video that's going to happen here in just a second. And of course, as always, if you have any questions or any thoughts come to mind, please let us know. Reach out directly. We're here to be a resource. Cheers. Mid-year market review and commentary. Market update. As the media has reported, the first half of 2022 was the worst start to a year for the stock market in over 50 years. And it was the worst start to the bond market ever. We are currently in a bear market. This is not something to be feared, just understood. I share 3 important points to maintain good perspective. The history of the market is still being written. Worst ever and best ever will continue to occur. The media will have a heyday with it. We simply accept it as a fact of life and stay out of the mess. While bear markets are very uncomfortable and can instill fear, they are an essential element of healthy capital markets. They squeeze out the excess, encourage companies to become more efficient, and pave the way for the next bull market. The greatest asset an investor has is personal choice. We cannot control nor predict markets, but we control how we respond. Many will choose to sell in the face of losses. It is better to exercise patience and strategic ignorance, choosing to ignore financial news and account values until these things get worked out. Inflation and recession. We are in a period of high inflation. While it may not keep going higher, these elevated levels will likely persist for a while. With the Fed increasing interest rates and tightening money supply, quantitative tightening, there is a decent chance many global economies go into a recession. A recession is often the cure for the disease of inflation. A recession is preferred to inflation. Expect the media to try to instill fear about an upcoming recession. We acknowledge the facts, but need to stay clear from the fear-mongering. In past recessions, we usually suffer a significant increase in unemployment. But this time around, unemployment is quite low, and companies are still trying to hire. Unemployment may increase, but given the current low levels, it is uncertain how much of a factor this would be to the overall economy. We are still writing the history of markets and economies. Looking forward. Anticipating what we may experience and how we may feel can help investors make better decisions. We should expect the media will promote every piece of negative news they can. Fear sells. We should expect to get concerned and perhaps feel some fear about the future. In fact, the more we tune into the media and look at account values, the more fear we can expect to feel. And the more fear we feel, the more we may be tempted to make a very unwise decision. We can also learn from history. Remember back to March of 2009. It was ultimate despair after going through over 2 years of a global financial crisis with little hope that things would change. There was nothing positive to look forward to. And yet, that was when the market hit bottom. Since March 9th, 2009, the market compounded at 17.6% annually for the next 12 years. Those investors who stayed in the market participated in that increase. During these times, the best thing to do is focus on what you control. You control your spending. You control what you pay attention to. You control the investment allocation, which was constructed with the expectations that recessions and bear markets will occur. While it can be uncomfortable to live through, none of this is unexpected, nor outside the realm of what happens in healthy capital markets.